Step 2 is getting really clear on your values, then your vision, like what you actually want. And then you can start being really intentional with your spending, saving and investing. Like that kind of whatever your earning level, whoever you are, I follow that same process with everyone, because if you haven't got the relationship with money bit right first, got clear on what matters to you, you basically won't feel in alignment later on when it comes to the spending, the saving and the investing.
This episode is sponsored by Saxo Markets. Welcome to the Investing Insiders podcast, where we help you achieve financial well-being by making smarter money decisions. I'm Brianne, and in today's episode, we're going to uncover how you can achieve your financial goals using the power of investing. So whether you're an experienced investor or just starting out, we've got some tips to help you along the way. Joining us today is Ponniah, a chartered wealth manager and financial coach with a 14-year career in investment management. Philly, welcome to the show. Thank you so much for joining.
Thank you so much for having me.
So when we think about building our dream life, we're often signposted to things like savings and putting money away to get to where we're hoping to be. And in some cases, we might just have our fingers crossed for a windfall or maybe even a lottery win. But investing can offer an option in the right circumstances to help you grow your wealth. So I guess before we dig in, Philly, it will be great to just get a simplified version of what investing is and how it works.
Absolutely. So investing is essentially putting your money to work by putting it into the stock market. You can then generate some returns over time, hopefully. No one can ever guarantee this. But unless, if you keep your money in cash, you'll get an amount of interest, but essentially that will just stay quite stable. Whereas if you invest, you're taking part in the ability to grow with companies' growth. So you're investing in slices of different companies if you go for a fund, and you basically can grow your investment by partaking in their growth. So it's a way of betting on companies, essentially.
Amazing. And I guess some things that people kind of have in mind are, what kind of things can you invest for? Because it kind of feels like, this kind of big financial thing, but what are the types of things that you can actually use, investing to get a hold of in your life?
Well, I think it's always getting really clear to start off with what you actually want. So, the FCA will always say, don't invest if you need the money in less than 5 years' time, for example. Preferably, you're investing for the long term. So if you know that you need the money for something specific, perhaps you're putting it towards a property, if you're hoping to buy that in 2 or 3 years' time, some people might be happy to risk putting that into the stock market, but if you know that you'd be really disappointed if that had gone down by the time you needed it, you should not be investing it. So time horizon plays a big part in it, as does risk. You've got to be comfortable that if you invest your money, that it could go down as well as up. When you've got that longer time horizon, you can kind of zoom out. You allow for more ups and downs along the way. But in terms of what you could actually invest for, getting really clear on what does it actually cost to do what you would like to do. So for some people, they'll be thinking about retirement and how much income they'd like in retirement. That's obviously quite a long way off for some people. And it can feel a bit intangible. But if you know what size pot you need, then starting early and putting aside for it, you can kind of grow over time. And if you know that you need, say, £40,000 in retirement as your salary, you then know you're working towards a sort of £1 million pot. That's just a sort of rough example using 4% as your rate of what you take out. But so you've got the longer term things like retirement. And I just say with shorter term things, say maybe it's sort of taking time out like a sabbatical or something like that. You've always just got to be mindful of that longer time horizon, that it's not something you're going to be doing next year, something that you're going to say, this is something I want to do, maybe like when you're 50, for example. And then how many years away is that? And can you then put money aside for that, from a younger time?
Yeah, amazing. I mean, it almost sounds like a bit of reverse engineering. So working out what you need and then, kind of taking the steps back and putting the money into wherever you need. In terms of investing, I guess, what are some of the benefits that could potentially help people grow their wealth?
Well, I mean, it's that if you leave it as cash, the cash will not grow very much. In fact, inflation will cut into your cash savings. So you're essentially losing out if you don't invest. And I think the UK is not that good at investing, and we're very good at being told to put money into savings accounts. But actually, really talks about the risk of not investing.
Mm.
And actually, so in terms of the benefits of investing, well, the fact that it will typically outpace cash over time. And, as long as you've got a diversified investment portfolio, you should be able to outpace inflation. And then, your money can maintain it and grow its purchasing power.
Yeah, definitely. And you kind of touched on this before, but I guess what are some of the things to consider that aren't necessarily kind of benefits towards investing? I think risk was one of the things that kind of popped up.
Absolutely. And it's that sort of, volatility can be unsettling. And if you're someone that would panic, and if there's a market downturn, sort of have you got savings that are put aside that you could access in those times, that you don't need to take your money out when it's at a lower point, because that's like the worst time to take money out. So I guess, so this other disadvantage of investing, maybe sort of if you don't understand the different asset classes, or even just things like tax wrappers, that sort of the stocks and shares ISA is probably the way to start, because that's a tax-free environment. If you feel that there's like some complexity, you do need to put a bit of time in to understand it. And for some people, it can get overwhelming, and then they either sort of freeze or make poor decisions. So like not understanding some asset classes. Crypto, for example, there's been some excellent growth in some cryptocurrencies and others not so much. And that can really burn someone if they make one move that's wrong. That might lead them to never invest again. So it's really just starting from a sort of sensible, diversified place where you don't need the cash if it goes down.
No, definitely. And I guess when kind of thinking about the pros and cons, I guess some people might be thinking, well, looking at, say, a savings account, if I can get an interest rate that pays above inflation, whatever the rate is at the time, is that maybe a better option for me than putting my money into, investing in, say, stocks and shares or whatever? Is there ever a case where investing, well, actually, let me take that again. Is there ever a case where savings could trump investing for somebody's circumstances?
Absolutely. It's got to be for those long-term goals. If you're someone who's really risk averse and you just do not want to put any of your money at risk, then you shouldn't invest. That's absolutely given. And actually, when I was an investment manager, we used to have to fill out these risk profiling questionnaires of clients before they give their money to manage. And sometimes they would actually say, no, I wouldn't be comfortable with even a 5% loss. And you'd have to say, okay, well, investing isn't right for you. Some people just have to take the fact that if it stays in cash, it won't keep up pace with inflation likely in the longer term. And then also just thinking about if a huge cash amount builds up and it's not within a cash ISA, the rate sometimes looks like it's better than inflation, but actually by the time they paid tax on savings, and that's something that's lesser known about. I think because low interest rates are so long, people weren't getting much money on savings in the bank, that now they're surprised if, you can only have £500 if you're a higher rate taxpayer before you pay interest, cap tax on the interest. Or actually for an additional rate pay, there's no interest you get before you pay any tax. So sometimes that eats into returns as well.
That's really interesting, because I guess what seems like quite a simple and quote unquote safe option can be a little bit more complicated when you dig into it.
Yeah, absolutely. Absolutely.
So for somebody who, is looking to take their first steps into investment, what types of things do they need to do to make sure that they're ready to take the plunge?
Well, I would, first of all, make sure they've got that foundation in place. So if they've got any high interest debt, I would start by paying that off first. You can still have some debt and start investing, but I think you have to start with anything that's high interest in terms of debt. Making sure you've got some sort of peace of mind fund. You might hear that called an emergency fund. I like to make it slightly more positive. And for some people, that will be 3 months of expenses covered. Some people, it will be 12 months of cash. And that will typically come down to, how quickly should they get another job, for instance, if it's because they've lost a job, or if it's covering costs. What's likely if something happened and their circumstances of money changed, what would happen in that scenario, and then how much cash they actually need to cover that. So I'd make sure I'd got high debt cleared. They sort of established the Peace of Mind Fund, make sure you're putting money into your pension to start with. I think those three things. And then it's getting clear on your goals and your time frame. So how much money each month can you put aside for the long term that you don't need in the next 5 years? And also then sort of how much risk you have to take on. So that's the sort of the initial bit. And then since I've trained to become a financial coach, I've got a lot more in touch with the psychology of money and how fundamental that is too. So getting clear on, what are the messages you're telling yourself around money, because our relationship with money is formed before the age of 7. And so if you've got some little narrative going on in the background that's going to sabotage, anything that happens, if you're going to panic, if your investment portfolio goes down, or, if you don't feel it's safe to invest or something, internally it's actually working on that. So there's quite a lot of steps to take before you then, educate yourself on the basics. So, thinking about what tax wrappers are available to you. Is that stocks and shares ISA you want to start with? It's not about becoming an expert, but it's about feeling comfortable that you can kind of stay the course if markets get volatile.
I think that's such an interesting point that you've raised, because I think there's a growing awareness of how our psychology behind things motivate or demotivate us to do certain actions. So I guess kind of thinking about our financial habits and things that might have formed and might be bubbling away under the surface, how important would you say it is to also address those before taking the leap into something like investing?
Massively important. I work with lots of very intelligent people, really successful people, and then often they're sort of paralyzed to get going because they've got these underlying beliefs. I'm not good with money, or something like investing is gambling, or it's something I'll mess up. If they always achieve in every area of their life, starting something that does feel a little bit new, certain patterns around behavior, excessive caution, all kind of analysis paralysis. So they kind of do so much research and then they actually don't start, or a bit like I mentioned before with the sort of panic selling if markets go down. So I think if you believe deep down that you don't deserve wealth, or that somehow having money is wrong, you may sort of sabotage the success of it. So I think one good thing about it is that awareness is that first step. So recognizing where those money beliefs come from, and then, separating them from you as an adult, where you can kind of question, is this true? Is your brain trying to keep you safe? And then sort of starting the rewiring from there. So it's as much about the psychology as it is about kind of getting, an understanding of the market.
No, definitely. Because I think when it comes down to it, I guess that why and those core beliefs are the biggest drivers behind whatever we do, whether it's financially or just in life generally. Sometimes you don't necessarily start questioning those things until you get yourself in a situation where it's like, okay, I'm not exactly where I want to be. How did I get here? And I guess you start working backwards. Are there any ways in which people at any stage of life can start to evaluate those, beliefs around money, and what kind of questions could they start asking themselves to dig into that?
So a good one is just get a clean piece of paper in front of you and just write at the top, money is, and then just, set a time for 2 minutes, write down all the things that come to mind. So no censoring yourself, just free write. And, I often do this if I'm like running a workshop or doing a talk, and then the different words that come up are quite interesting. Some will be positive, some will be negative, some will be positive and negative from the same person. And that's always interesting because, we are not one-dimensional people. Some people it might be money is security or freedom or safety, or, often like money is the root of all evil. Like some of these phrases will come up that are kind of cultural or religious. And so having a blank piece of paper and just sort of thinking about what comes up for you around that, thinking about your earliest memories around money. Sometimes it'll be that there was plenty of money. Sometimes it'll be that there wasn't money. And kind of, some people, there was plenty of money, but maybe there wasn't sort of love or warmth or safety, or, there's all sorts of different scenarios. And so it's understanding what your situation was, and then acknowledging kind of what's different now. Is it true? The sort of messages. And it's very much a sort of new devil. So I kind of work with people, all the way up the income levels or revenue levels in their business. And actually, it's amazing how you can be triggered when you kind of earn something with an extra zero, or you then kind of almost sort of like you're destabilized again. You have to check back in with, what's true, what do you actually want to be true, and what do you want to be telling yourself. So it's often an ongoing piece of work, as opposed to a one and done type thing.
Absolutely. I think that really ties in with the concept, I guess, of just being very present and aware in all aspects, especially with your finances. One of the things, I guess, that can also help with that is potentially budgeting, if that even comes down, on paper and comes down to writing it down on paper as well. To what extent do you think people should consider creating a budget or just having an idea of, where money is going and where it's coming as well before getting involved in investing?
It's really, really good idea to know where your money is going before you start investing, because then you can make any changes and also then work out if you've got more that you can put aside to invest. So I try not to use the word budget. I think it's a bit restrictive, but if you have some intentional spending plans, always the process I follow when I work with people is, getting clear on that relationship with money, one of those messages. Step 2 is getting really clear on your values, then your vision, like what you actually want. And then you can start being really intentional with your spending, saving, and investing. Like that kind of whatever your earning level, whoever you are, I follow that same process with everyone, because if you haven't got the relationship with money bit right first, got clear on what matters to you, you basically won't feel in alignment later on when it comes to the spending, the saving, and the investing. And so you could then be far more intentional with what you say no to, as well as what you say yes to, if you know what matters to you. And I feel like that really is what changes things for my clients, when you're really clear on what matters. And then with the spending, you can allocate money to various things that align with your values. There'll always be the things you have to spend on, but when it comes down to that more discretionary spending, you don't feel so hard done by, for example, if you know you've got a portion allocated to something that kind of lights you up.
Definitely. I guess with you working with so many people, what are some of the common misconceptions that have come up around, I guess, investing? And when people are digging into their money stories and beliefs about it, what are some of the things that come up that might be preventing them from taking that step when they might be in a good position to do so?
Yeah, well, I might actually just start with me, because I was an investment manager managing, millions of pounds, and I didn't actually start investing myself for 3 years of being an investment manager. So if even I, who was managing so much money for other people in the stock market, wasn't doing it, then I can sort of see why others weren't doing it. I do think we've had a very good sort of democratization of wealth and how you can invest since I started in 2011. So you can now get going with, £10, £20, £25, those smaller amounts. But that was, I guess, the misconception is, you need loads of money to start. I think, changing that to actually knowing that, regular investing actually works. That pound was averaging. You don't need loads to get going. So that's a big plus for the democratization, I'd say, of investing. People thinking that they've missed the boat. I think, that expression of like, best time to start was years ago, saying best time is now. That idea that it's too late for you. Again, I would always just come down to when do you need the money. So yeah, it might be too late if you need the money in 2 years' time. So it's not that it's right for everybody. And then I just think maybe potentially people thinking about investing as gambling. Maybe they've experienced something in their childhood or seen someone lose a lot of money by investing in one stock that tanked. Investing, it's not the same thing depending on what you invest in. And I think some people view it as something that's highly risky. You can choose things that are highly risky, but actually if you can build that diversified portfolio, it's not nowhere near the same level of risk as investing in just a single line stock.
Absolutely. And I think potentially people's confidence around money might play a role as well. To what degree do you find people not necessarily having the confidence to take that step? Either, leaning back on their core beliefs or just, I suppose, maybe seeing risk and just saying, I'm not too sure, or that's not for me?
Well, I do a group coaching program with women, and I find by teaching them the basics, they can then build up their confidence. And also then seeing their peers who are sort of earning at a similar level to them, when they see that they've started, they realize, oh, I actually can do this too. And I had a session with my current cohort on Monday night, and we were sort of checking in sort of 2/3 of the way through, like, how was it all going? And they also said that it was that psychological side of things, but also just getting going and seeing that it wasn't actually that difficult. Actually, it was just that little nudge ahead with, it's okay to do this. It's, stocks, shares, ISA to start with. And basically just educating them, and then they can go and decide, where they want to open their account, what they can put in. But having gone through that, getting clear on, what can they proactively put aside at the beginning of every month. But the confidence actually comes quite quickly. And then can have a huge impact. And obviously, you don't have to come and be taught it. There are plenty of good books you can read to go and do it yourself as well. So, yeah.
No, that's great. And I love the community aspect of that as well, because I guess sometimes the conversations that you have could help, I guess, encourage you to take that next step. I guess one thing that is quite interesting to maybe dig into is how important is that aspect of community when you're either just starting out on your investment journey, or, you're well on your way, but maybe you've gone solo. Do you need to seek out other people who are kind of on the same trajectory to, bounce ideas and things like that?
So I've seen it be very positive with the kind of group coaching I've run, and particularly for getting going, and then also sort of having check-ins every so often just to see how you're getting on. But it's that element, that sort of peer element. I've found there have been people at sort of similar stages, such as like returning from maternity leave, that it has been beyond the investing that has been a great community aspect. So that supportive element has been a really nice bonus. So most of us, you don't go around with your salary on your head, knowing what other people earn is actually then. And especially, I think, when people are either the first in their family to earn a high amount, where there's no one then that they feel comfortable talking about it with at home, or, with parents, or, in the friendship groups, and people aren't earning the same amount, that there's actually something really reassuring and safe talking about it in a community where it's sort of okay to talk about this. So I think it's really important. You obviously don't need to be part of the community, but I do think there are benefits. Yeah, shared learning, accountability, and just making it a normal part of conversation. So I spoke at a breakfast last week, and afterwards everyone was just saying it's so nice to have all of this permission to all talk about money, because it's still so taboo, but when you talk about it, just good things happen. It's great.
I think that's such an important point, because I totally agree. I still think, although, we've made a lot of changes and people are starting to open up a bit more, money still is quite taboo. It's not really something that, can just ask anybody about. There kind of does need to be that almost safe space created where everybody can join and talk about things too. One of the things that we've kind of been working on is trying to generate more conversation around money. So we're currently working on like a book awards where we're talking about different financial books and inviting people to discuss different elements of, their finances and things like that. So hopefully over time things will get more people will get a bit more comfortable with it. But I can definitely kind of resonate with that too, where it's like, you don't necessarily really want to talk about salary, or you don't know if you can say, oh, how much is a good amount to save? What's your savings journey been like? It can just feel you can just feel a bit of resistance before opening up.
Absolutely. And I had one person ask me sort of about what's the amount you should be saving. I always take the words should out of your vocabulary. It'll be very different. But, sometimes I tend to typically attract people where it might be the females, the higher earner in a couple. But if you've got two high earners in a relationship, then it's very different what percentage you should be or can save versus if you actually are carrying a lot of the weight of the household spending. So it really is personal, but it's good to sort of work out what do you have to spend, what do you choose to spend, and then what would you like to put aside for future you. You can be intentional with that.
This episode of the Investing Insiders podcast is sponsored by Saxo Markets. Saxo provides access to a broad range of global assets through a sophisticated trading platform. You can trade US stocks from as little as $1 per trade and UK stocks from $3 per trade. Please remember that all investing involves risk. The value of your investments can go down as well as up, and you could get back less than you invest. Terms and conditions apply. Visit Saxo Markets to learn more. you kind of touched on this already in terms of the types of accounts that you can use to get started with investing, a stocks and shares ISA being one of them. What other types of accounts can you use, and where would you even go to kind of get a stocks and shares ISA if this was your first time getting into it?
Well, I think it would depend on what you want to invest in. And so there are some platforms that will only let you invest in passive funds. These ones that sort of track some investments. So just for example, Vanguard and Invest Engine only invest in ETFs. So that's just something to be aware of if you wanted at some point to also invest in either other funds or single line stocks, then that might not be right. But you can also have two platforms that you choose. So some people will choose to have the bulk of a portfolio that's passive and then potentially individual lines of stock through another provider. I use Hargreaves Lansdown for my children's junior ISAs. They're free and they've got research on them. So it just depends on what you want. I have my SIP with AJ Bell. That's my self-invested personal pension. And that's because I'm a limited company. And so I can put money from my business into that SIP for future me. And you've got to think about things like, what's the user experience like on these platforms? Does it have an app? What's that like? Is customer service there? There's sort of lots of things to think about. And I'm sure there's lots of analysis on your website as to what's good or not. But it's just thinking what suits you. There are various ones that are free. There are various ones that are paid for. It's just got to be what suits your needs, essentially.
That's, a really good point about thinking about what type of investment journey I guess you want to have. I guess what's great now is that there are so many apps or web forms of, these investment platforms that you can get started on. Whereas there might be, this conception that investing takes place in the boardroom, very Wolf of Wall Street, very, inaccessible. But it does feel like there's a lot more options now if you just wanted to, try to dip your toe in and see how it goes.
Yeah, and that sort of gamification and in encouraging sort of extra saving, extra amounts into investments. I think that Moneybox is quite good at that. There's a little animal that comes out and says, do you want to invest more? Just thinking about what's going to make it more tangible for people and actually encourage the nudging behaviours. I think behavioural finance is a very interesting topic in itself of what's going to make someone connect with, say, future them and putting money into a pension when it seems quite far off for most people and they can't imagine what costs are going to be like then, and they can't imagine, will they have paid off their mortgage by then? Will they still be renting? There's all sorts going on that, I think, that's a big issue actually for the country.
It does really feel like things are changing at such a rapid rate, and no 2 years are even looking the same, even over the past decade, I'd say. But I suppose that's a really interesting point about creating a strategy or connecting with the future version of you. What are some of the steps that people can take to make sure they've got something that helps them work towards that? Obviously, things might change, but just having that kind of, roadmap ahead, what are some of the steps people can take to bring that together?
So I think it's getting clear initially with that goal. So not just thinking like, I want to retire comfortably, but maybe it's working backwards. We talked about that reverse engineering. So if it's £1 million pot you need, what do you then need to be putting aside each month? There are some good calculators. There's one by the government, and then platform providers tend to have some calculator of some sort where you can put in what you're earning, what you're contributing, what your employer contributes if you're employed, and then how will that compound? They choose a growth rate that's fairly realistic, so that you're not kind of doing everything particularly punchy, and it sort of shows you roughly whether if you tweaked it now, how would that impact you? And most people earn more as they get older, so that's a good thing, but not to delay just because you think you're going to earn more later, because time in the market is going to compound for longer. So that's a positive. So getting clear basically what you want to get to, working out what you need to be investing regularly to reach that target, being realistic with the growth rates, and then I guess thinking about asset allocation. So what are you going to be putting into equities, bonds, any other assets, and that's got to fit in with your risk tolerance and your time frame. Higher equity exposure if you've got longer to invest, and then just thinking about your investment vehicle, because you've got the pension for the longer term. Some people want some flexibility, so they'll also be building up their ISA so that they could potentially live off some of that ISA before reaching their pension age, and therefore when they can access that pot of money. And then I think to review semi-regularly, but not all the time, because actually there's sort of damage to be done if you go in and tinker with things. You want to be investing in the long term, choosing, and then rebalancing if it's needed, but sort of more just thinking about putting more contributions in when possible, and then kind of staying focused on that long-term plan rather than kind of short-term noise, which can be really unhelpful.
It really can. And I guess in some circumstances, it can be a bit destabilizing because it almost feels like a crisis. It's like, oh no, this has lost value. I feel like I should act now. I guess if anybody finds themselves in that situation, what is the process of actually looking at it, maybe just taking a step back and then trying to put some analysis on whether or not there's, the right time to make a move?
Yeah, so I think still being mindful of when you need the money and the time frame. But historically, markets have recovered if they've been given sufficient time. I'm not talking about sort of single stocks that potentially something's happened in the company and then the value is kind of never going to go back up. But I do think, continuing your regular contributions, because you're now buying the units at lower prices, so that will benefit you when the market recovers, and that's that pound cost averaging that I was mentioning before. I think, again, avoiding checking the portfolio constantly. You don't want to be looking all the time. It can really impact your psychology if you're thinking, down again today, that can lead to poor decisions. I think if it causes genuine distress, it might show that your portfolio is too risky for your actual risk tolerance. And then maybe once markets stabilize, it's something that you can adjust. But I'd always try and say not to panic at the moment things go down, because otherwise you're just locking in losses.
That's such a good point. And I guess there are different kind of ways to go about investing. There's the kind of more active approach where you do need to do, I guess, a lot more research and play a bigger role in moving things around. I suppose for people that are keen on investing but want a slightly more let somebody else manage it or let this, investment vehicle take off and do its own thing, what kind of options do they have available to them?
So I used to be an investment manager. People would give us their money and we'd invest it for them, taking into consideration what they wanted, any ethical preferences, any sort of restrictions they would just put on the account. So actually, if it was like a charity and they didn't want anything, the sort of so-called stocks. And so you can either go to a sort of traditional wealth manager at a certain level of assets to do that. And one place we need £5 million as a minimum, and one place it was 100,000. So, obviously depends on who you choose to go with. So that's one option. That's sort of either bespoke, or you might still be put into a model portfolio, but you'll basically be given a person who can look after your money for you. Then the next option is probably going to a platform where they've got a model portfolio. So someone is choosing an overall strategy for a risk level and an objective that suits you. So maybe it might be an income objective. If you want income from the portfolio, it could be a growth one. Sometimes you can get a mixture of the two, so more of a balanced approach. So that's kind of like your other option if you still want it done for you without the sort of fees and personalization of a sort of traditional wealth manager. And those are probably half the price of a traditional wealth manager, but still sort of maybe 45 bits, 50 bits.
And for people kind of looking at different investment opportunities, one of the things that often gets brought up as you need to beware are things where they're kind of promising returns overnight. So it's almost like you put some money in and it's going to be, tripled or quadrupled by tomorrow. What type of opportunities are, too good to be true? How can people spot them? And what steps should you take if they ever kind of float past you, or you might hear it in passing from someone that you know or on social media?
Absolutely. Well, I unfortunately get my account cloned all the time on TikTok, hundreds and hundreds. And then it looks like it's fully financial, but actually it's got a 1 instead of an I, something like that. And they target my followers and pretend to be me in the DMs and offer them, really high returns. Anyone who's worked in the industry knows you cannot promise an investment return, let alone say, you're guaranteed something. You definitely want to be wary of anything where it's guaranteed, because anything that's regulated cannot guarantee you anything. So all investments will carry some risk, but the ones that they say are like higher returns is usually higher risk. And sometimes it's just a scam. So those people are actually just trying to get people's money from them, pretending that they're going to invest it and actually just taking the money. So I think being wary if perhaps someone's trying to sell you some insider information. You obviously don't want to go to prison for investing in something that's being given as a tip-off. So I think that's one to worry about. And then you just want to check and see if things are regulated by the FCA, so Financial Conduct Authority. If it's a legitimate investment, they'll be transparent. They'll be, it'll tell you transparently about its risks, and how they're regulated. And then I guess, there are always other ways, sort of like pyramid scheme type things where, if the person selling you says, you will need to get other people in to help make the money. There's a lot of people preying on new mums who basically don't want to go back to work. So they basically try and get them into like digital reselling or things that are just basically pyramid schemes, but it's really sad because they're preying on the vulnerable. And it's usually the vulnerable who will think, oh yeah, I need a 50% return. Of course, I'll give you £2,000, and that £2,000 is their last £2,000. And I'm thankfully a lot of people who follow me don't fall for the scammers, but there are other financial content creators who are in a WhatsApp group together, and sometimes they'll send messages, and it's really sad when they then get angry messages from their followers where they've been taken. They've given money over thinking it is the person, and because they're a bit more desperate, they've then thought, well, no, I've followed this person for a year, I trust them, and sent the money. So I think it's just anything that sounds too good to be true probably is, and then just looking to see if it's regulated.
It is really heartbreaking, especially when it comes to the scams that, go around and use somebody who has a credible platform and, try to kind of clone what they're doing. Millions gets lost in investment scams every year. So it has to be really, really kind of debilitating when you find out that you've handed over money to something that just didn't really exist. Some of the ways that we've kind of tried to highlight that you can check to see if the person getting in touch with you is potentially a scammer is looking at things like the user handle for the person messaging you, because sometimes there are like really slight deviations. It might be like a full stop after a certain name, or maybe a dash or something like that. Again, one thing that you mentioned was if somebody's putting pressure on you to say, you've got like 10 hours to invest in this great thing.
Secure this deal. Yeah.
It's probably unlikely to be true. I've definitely received a couple of those, either randomly because I've signed up to a newsletter or something, so somebody's got my email, or like gotten a random text where it's like, oh, you can just give me 500 and it will turn into, was it like 10,000 tomorrow? And obviously I'm looking at it and I'm just like, that's ridiculous. But I think depending on where you are, that can look quite appealing, especially if it seems like it's coming from somebody you know.
Absolutely. Having said that, I got quite cross on behalf of a client recently who has got various different credit cards. I'm helping work with her to pay off the money she's borrowed. And on one of them, she was only paying back the minimum repayments, and it was like £2,000 on that card. And then she got a letter to say, basically, like, act now quickly to secure £3,000 of credit. And she said, she sent a message saying, isn't this awful? Now that I'm working with you, I realise this is wrong, and I won't accept it. But the way it was phrased was, you need to accept this. You might not get this offer again. And for anyone who's feeling stretched, they might go, oh, yeah, actually, I'll need that. And then they might spend on that card again. And the rate of interest was 24%. So she happens to be a high earner who ended up spending, basically more than she had. But it's not going to take too long. For that's going to take 18 months to pay off the 35,000 that she owes, because she's a high earner, and it's just about getting mindful of it and changing some things, and she'll be fine. But if you think about someone where that's a big portion of a monthly salary, It's really damaging, and I absolutely hate to see it. So that is from a regulated, lender. And I think that sort of behaviour is really wrong. When I grew up, my mum worked at Citizens Advice Bureau like my whole childhood. And so she'd always come home with these awful stories of debt where people hadn't understood APR. So I always have a real sense of sort of injustice and sadness when I see it on, this woman luckily has realised she needs help. I'm helping her, and we've kind of got a plan with rewiring what's sort of messages around money. But, most people don't have that. I mean, there are some good charities out there, but unless you are resilient to say, no, I don't need that extra line of credit, it's really bad.
It can be exceptionally tempting, especially depending on your circumstances, A, and then B, I find that the promotional stuff around credit tends to ramp up around Christmas or the holiday season when, it's time to potentially spend a bit more. All the deals come through. And like you say, they've got this, you've got a week or, there's a deadline to sign up to this new line of credit when that may not necessarily be great for you long term.
Yeah, exactly.
And I guess potentially that kind of ties back into what you were saying about having that plan mapped out, where if you do get something like this that comes through, maybe you can kind of look at that plan and say, well, this might be like an appealing and interesting prospect, but does this match up with where I'm going? And it sounds like, your client kind of had that, and obviously your support as well, to just be like, this may not be the right step to take.
Yeah, absolutely.
In terms of getting kind of additional support when it comes to creating your investment strategy or plan or just getting your finances together, some people might be considering things like financial advice or coaching. It would be great to kind of get your opinion on the difference between the two and what people should consider when deciding if they should have one or the other, or potentially both.
Absolutely. So there is quite a clear distinction between the two roles, and someone who has been regulated and now isn't, because coaching isn't. Coaching is guidance, focusing on the relationship with money, behavior change, building confidence around financial decision. That's sort of educational and supporting your decision-making process. But, financial coaches don't tell you which specific investments to buy. It's sort of psychological and educational work. With the financial advice, it's regulated and, providing specific investment recommendations. Typically they'll help you choose, particular funds or, what tax wrappers to choose, and manage your investments. And I'd say that's like the technical aspect of wealth management. It can be really helpful if you inherit money or you're planning your retirement or staying of a business, significant like life transitions, getting divorced. It might be that you come and actually work with a coach first to work out, what you actually need, process the sort of emotional side of things before then you can say, actually, I've got a lot of money that will need investing. And then you might choose to go then to a financial advisor or an investment manager. But I find actually that everyone is happier if they've had a bit of the sort of love around the sort of emotional side of things before, and habits before they then seek financial advice. So I very often refer on to a financial advisor once I sort of feel like the foundations are in place psychologically, behaviorally, and then you can actually kind of get going on a really firm foundation with the advice piece.
I guess that sets a very good foundation in terms of mindset that can transfer into building the life that you're looking for through other financial vehicles. I guess, what is one piece of investing advice that you wish that everybody knew?
I'll probably say it's about time in the market, like beating that timing in the market. And sort of, I think one of the biggest mistakes people make is waiting for the perfect moment to invest, after the next election or when markets settle and when they understand more, if they've got that feeling of kind of the need to analyze everything. But I would say perfect moments never arrive. You'll never know it's the perfect moment. So it's actually just getting going consistently. As soon as you're ready, you've done that, paid off your hire down, paid down debt, got your peace of mind fund, got those bits I mentioned earlier sorted, and then just kind of stay invested through those ups and downs. And we then got compound growth to work over the decades, basically. So I think that will be much more. That's much better than kind of being clever around that entry and exit points and sort of day trading.
And is it ever too early to get started with investing?
Some junior ISAs have started the day children are born. So, they get that money aged 18. Some people choose to do the junior SIP. So that's the pension for their children. I personally chosen junior ISAs for my children as it goes for the pension. I'd rather see them enjoy the money in their, 20s and 30s earlier than having to wait till retirement. But it's not to say you can't do both. But I don't think it's ever too early to get going. I do have some parents come to me who want to know how to invest their children. And I always say, are you doing it for yourself first? And that often ties into something about how they view themselves, maybe as not worthy, or, there'll be something psychologically going on. It's lovely that people, I've got 2 children. It's lovely when people do want to provide for their children. But I would always say, make sure you adults, are doing it for themselves as well, so that they are kind of building up their own wealth, because then you can choose to give at a later stage. Not to say not to do junior ISA. I think it's a great opportunity in that tax-free environment, but just to make sure you're doing it yourself as well.
And I guess it also maybe opens up that conversation around finance on both sides. So the children kind of get an example of, this is what my parents are doing, and I can maybe ask them about certain aspects of it. And it kind of just normalizes it, I suppose, when the time comes to them potentially taking over their own investment account or opening their own.
Absolutely. And I encourage conversations around money and values and what you're choosing to spend on, all like positive, expansive language around money, rather than saying things like we can't afford that, which, might send the wrong signals. It can be that you're choosing not to spend on that. And that's a much more positive place to be.
And I suppose on the other end of the spectrum, is there ever a time when it might be too late to consider investing?
I would just say potentially around that time horizon piece, if you were, I don't know really, actually. Only if you know you need the money, I think not to invest. But, there are some very old people who invest, and it's absolutely fine.
Amazing. And if you could go back to your 18-year-old self, what's one piece of financial advice generally that you'd kind of give them as a tip?
I would definitely have started investing early, even if it was like £20 a month. I'd have started with that, because as I said, it took me 3 years as an investment manager, managing millions, and I wasn't doing it myself for 3 years. So I think just getting going that bit sooner, that would have made a difference. But still not getting at a good time.
No, absolutely. Now it's time to dig into one of your listener letters. If you've got a money question, send it in to podcast@investinginsiders.co.uk and we might read it out on a future episode. Today we have a question from Emily, and Emily asks, if you have absolutely zero savings, which should you go for? A cash ISA or a stocks and shares ISA, or potentially both?
Very good question. I'd say if you've got zero savings, the priority is building up that peace of mind fund in a cash ISA first. And that could be anything from like 3 months, 6 months of sort of those essential expenses where you're easily accessible, because that just is your financial foundation. And without that, if you have unexpected expense, it forces you into probably more expensive debt. So you want to make sure you got that first. But once you've got that established, and it might not take you too long to get there, then the stocks and shares ISA for the longer term goals is a great idea. So you might end up with both the kind of cash ISA for that peace of mind fund and near term goals, and then the stocks and shares ISA for things that are kind of beyond 5 years. So that's probably my answer.
Amazing. And Emily didn't mention this, but if she did have any expensive debt, say on a credit card or like high interest loan, should she try and tackle those before even considering, going down the stocks and shares ISA route?
I think so. Yeah, I do. Because if you think, I've seen people with as high as 37% interest on debt. I mean, it's appalling. Someone 25%, 26%, huge amounts, and you're not going to get that. Definitely not going to get that in a cash ISA, but even in a stocks and shares ISA, 10% growth if it's pretty good. I know you can get much higher growth than that, but if we're just thinking for beginners starting out who maybe goes like a world fund or something like that, depending on the year and the performance, I'd say there's too many, what ifs. I'd want to be paying down anything that's higher interest, just because it's so expensive to pay back.
That's incredibly helpful. Emily, thank you so much for sending in your question. We hope that helped. Remember, if you have any questions about finance, send them into podcast@investinginsiders.co.uk and we might read them on a future episode. Billy, thank you so much for joining. It's been incredible to have you.
Thank you so much for having me. Really nice conversation.
And for anybody kind of looking to connect with you or follow you on socials, what's the best place for them to find you?
So I'm at Philly Financial on Instagram. My website's phillyfinancial.co.uk. And because someone thought I was under 13, my at Philly Financial TikTok's been taken down and I'm on This Is Philly Financial there.
Well, that is insane. But also we'll make sure we link everything in the show notes as well, so people can kind of click there and get there too.
Thank you.
Thank you so much for joining our Investing Insiders podcast. If you like the episode, please subscribe and leave us a 5-star review on your platform of choice. For the latest money news and deals, you can sign up to our weekly newsletter at investinginsiders.co.uk/newsletter-page. We've also got a suite of guides, tools, and calculators on our website at investinginsiders.co.uk. You can also keep up to date with us on TikTok, Instagram, and YouTube. Thanks for joining us, and we'll catch you in the next episode.